Good afternoon. At least it's afternoon where I am. And welcome to part 1 of rental property income and deductions. We're going to start on page 4-2 in your book. Okay. This will probably take 2 videos to get through. Okay. If you go to page X of your book, which is our Form 1040, and you go down to line 17, you will see where it says rental real estate royalties, partnerships, escorts, trusts, etc. attached Schedule E. All right. In your chapter, all right, if you go into your book and go to page 4-7, you will see a copy of the Schedule E. All right, at least the first page. All right, that is the page that you would use to put all the income and deductions for your rental properties on. You'll notice that there is room for 3 properties. If you have more than 3 properties, you would just file more than one Schedule E. All right, the results of Schedule E will pass through to line 17 of Form 1040. All right, so let's take a look at the bottom of page 4.2 and the top of page 4.3. The author really doesn't get into if you own a rental property and you rent it out 365 days a year. It's pretty much a given that you're going to report all the income, you're going to deduct all the expenses, including depreciation, and you potentially could have a loss. Okay, it's not uncommon to have a loss on rental property. All right, so the focus here isn't so much on a full year rental, but on a partial rental. Okay, because then you get into some problems with allocation. So let's take a look at page 4.3. All right, the first instance on there says primarily rental use. All right, I'm sorry, primarily personal use. All right, what this means is if you rent out your property, okay, be it, your personal home, it could be anything, and you do it for 14 days or less, then you do not have to claim any of the income from their property, which is pretty cool, especially up here in South Bend, where we're obviously a big college town with Notre Dame here, and so there are people that fly in sometimes for games, and most of the rentals I see up in this area, they want you to rent it at least 2 nights, so you'd probably stay Friday night before the game and then Saturday night and then leave on Sunday. All right, well, Notre Dame only plays usually 6 home games a year. So if you take 6 times 2, that's 12 days that you rented out your property, and you don't have to claim any of that on your tax return. Now, you don't get to claim any deductions for it either, except for real estate taxes and mortgage interest, but you would itemize those deductions instead of claiming them on Schedule E. So if it's primarily personal use, okay, then you don't claim the income, but you don't claim the deductions either. All right, keep one note here that since you're not claiming anything, obviously then you cannot claim a loss at any time if it is primarily personal use. Okay, then you have the second one at the bottom of page 4.3, and that's primarily rental use. Okay, so let's take a look what it says. It says, if the residence is rented for 15 days or more and is used for personal purposes for not more than 14 days or 10% of the days rented, whichever is greater, the residence is treated as a rental property. Okay? All right. Then what you have to do is you have to allocate it. So your denominator would be 365. your numerator would be the number of days that you are renting the property out. Okay, so you would take, that fraction times all of the costs involved with the rental property, including depreciation of the property, all right, which, by the way, is over 39 years. And you would put it on Schedule E. All right, now, unlike number 1 on page 4.3 and number 3 on page 4.4, okay, this one you can cause a loss. In other words, you can have a negative number on line 17 of your Form 1040, and of course also at the bottom of Schedule E. All right, so you do have to allocate your expenses. All right, they are going to be allocated in a certain order. All right, so you will first allocate the mortgage interest and the real estate taxes. You'll do that first. Okay, then you would allocate the utilities, and then finally you would allocate the depreciation on the home. All right, now, generally if it is a rental property, you're going to take depreciation on it. If it's your personal home, sometimes people don't necessarily take depreciation because they don't want to have to reclaim that depreciation in future years. But the IRS has a rule that they call depreciation allowed or allowable. Okay, so the IRS really doesn't give you the option of not depreciating your property. All right, you are supposed to depreciate it, take the tax deduction in the year that you rented it out. Okay, and then down the road, if you sell that property, you have to add that depreciation back and you have to pay taxes on it. Okay, so that number 2 on page 4.3, all right, is the only one of the 3 that can cause a loss. And it also mentions that on page 4.3 that you are subject to the passive loss limitations. All right, the passive loss form, if you go in your book, you should see it on page 411. It is Form 8582, and it is the passive activity loss limitations. Okay, just talk about what that means for a second. All right, on a tax return, you generally have 3 types of income. You have active income, which would be your W-2s. All right, and any income from a sole proprietorship or a partnership or an S corporation. Okay, now I'm not talking about wages here, I'm just talking about income earned, all right, as part of an S corporation owner or as a partner in a partnership. All right, that is active income. All right, then you have portfolio income, which basically is interest and dividends. Okay, and those would be reported on lines 8 and 9. And then you have something called passive income. All right, passive income is income derived from investments where you normally don't have any active participation in it. All right, so for example, somebody asked you for a $50,000 loan to buy a rental property. You give them the money, but you have nothing to do with the running of the rental property. You just gave them the money. In other words, you're the bank. All right, well, that's a passive activity. Okay, now the IRS does make an exception for property owners. Okay, even though it is a passive activity, all right, sometimes you're allowed to deduct losses that you wouldn't normally be able to deduct if it was a straight passive activity. Okay, all right, we in the next video, all right, I'm going to talk about that particular subject and about number 3 on page 4.4.